The number you see on your screen, the one splashed across financial news headlines every 3 months, the earnings per share figure that sends stocks soaring or crashing, that number, is a carefully constructed fantasy. It's a story, written by accountants and executives, designed to present a company in its most flattering light. And for decades, the investing world, from the retail investor managing their own retirement account to the high-paid analyst on Wall Street, has accepted this story as gospel. They trade on it, they celebrate it, they panic over it. But there is one man who has consistently, quietly, and with devastating effectiveness, refused to read that story. Instead, he writes his own, and his story ends with him becoming one of the wealthiest human beings in history. Warren Buffett doesn't just ignore the official profit number, he holds it in contempt. He views it as a distraction, a piece of accounting fiction that obscures the one thing that truly matters in any business, the single question upon which all long-term portfolio growth is built. How much cold, hard cash can I, the owner, take out of this business at the end of the year, while making sure the business is just as competitive as it was at the beginning of the year? That's it. That's the whole game. Everything else is noise. The metric he created to answer this question, a simple but profound calculation he calls owner earnings, is the single most powerful weapon in the value investing arsenal. It is the X-ray that sees through the body of a company, ignoring the superficial muscle of reported profits to examine the unbreakable bones of its cash-generating skeleton. Most investors spend their lives looking at shadows on a cave wall, mistaking the flickering images of net income for the reality of the business. They buy companies that post dazzling profits, only to find those profits are an illusion, consumed by endless, crushing expenses needed just to keep the lights on. They fall into value traps, buying businesses that look cheap on paper but are actually treadmills to oblivion, running faster and faster just to stay in the same place. Today, you will leave the cave. You will learn the formula that separates the financial reality from the accounting fiction. This is not about complex financial modeling. It is about adopting a fundamental shift in perspective. It is about learning to think not like a stock picker, but like the sole proprietor of a small-town business. It is about acquiring the CEO mindset. Whether you are an entrepreneur building your own company or a retail investor building your own wealth, by the end of our time together, you will understand how to calculate the real profit number. You will be able to look at any business, from a global tech giant to a local manufacturer, and see the true river of cash flowing through it. You will possess a tool of financial literacy that will protect you from the market's most seductive lies and empower you to identify the cash-printing machines that Wall Street, in its obsession with the official story, so often overlooks. This is the difference between guessing and knowing. And in the world of money, that difference is everything. Our journey into the heart of a business begins with a foundational truth, a principle so critical it forms the bedrock of all intelligent investing, the deep and often deceptive chasm between reported profit and actual cash. To truly grasp why Warren Buffett felt the need to invent his own profitability metric, we must first understand the profound illusion of net income. The number at the bottom of the income statement, the figure celebrated as the bottom line, is less a statement of fact and more an opinion, an accountant's opinion, subject to 1,000 assumptions, estimates, and legal manipulations. It is a work of fiction, and Buffett's genius was recognizing this decades before it became a fashionable critique. To see this principle in action, we must travel back to 1972. Imagine a world without the internet, without 24-hour financial news. Investment analysis was a gritty, hands-on business. In Omaha, Nebraska, a 41-year-old Warren Buffett, running his burgeoning partnership, Berkshire Hathaway, was on the hunt. He wasn't looking for complex turnarounds or speculative tech plays. He was looking for simple, understandable businesses that produced predictable cash. It was then that a unique opportunity crossed his desk: See's Candies. See's was a beloved West Coast institution, a family-owned chain of candy shops known for its old-fashioned quality and fierce customer loyalty. To the casual observer, it was a nice little business. To the spreadsheet-driven analyst of the day, it was nothing special. It was a mature, slow-growing company in an industry with no obvious technological moats. The C family wanted to sell, and their asking price was $30 million. Buffett's partner, the brilliant and perpetually unimpressed Charlie Munger, was immediately interested. Buffett, however, hesitated. Looking at the company's financial statements, the numbers didn't immediately scream bargain. The company's book value, the stated net worth of its assets on the accounting books, was only about $8 million. The net income, the reported profit, was around $2 million a year. A price of $30 million represented a multiple of nearly 4 times book value and 15 times earnings. By the conventional value investing metrics of the time, metrics taught by Buffett's own mentor Benjamin Graham, this was no screaming deal. In fact, it looked expensive. The 99% of investors would have looked at the price tag, compared it to the reported profit and asset value, and walked away. But Buffett didn't just look at the numbers. He looked through them. He began his unique process of fundamental analysis, one that treated accounting as the beginning of a conversation, not the end. He saw that the reported net income of $2 million was telling a profoundly misleading story. The key lay in what the income statement didn't touch up to pretty odd eyes, the company's true capital needs. See's Candies was a miracle of economic efficiency. To grow its sales, it didn't need to build massive, expensive new factories. It didn't need to pour millions into speculative research and development. To open a new store, the capital required was minimal: a simple storefront, some display cases, and inventory. The brand's power did the heavy lifting. Furthermore, the company operated on a float. Customers paid for their Christmas candy in November and December, but See's didn't have to pay its suppliers for the raw sugar and chocolate until January or February. This meant the business was constantly being given a short-term, interest-free loan by its customers and suppliers, a pool of cash that fueled its operations. The income statement had an expense line called depreciation. This is an accounting concept, a non-cash charge meant to represent the gradual wearing out of assets like ovens and machinery. For See's, this charge was quite small, but Buffett realized something crucial. The actual cash the company needed to spend each year to maintain its productive capacity, to replace the old ovens, patch the roofs, and keep the stores looking fresh, was even smaller than the depreciation charge. The equipment was simple and long-lasting. So while the income statement showed a profit of $2 million, Buffett's mental calculation, the precursor to his formal owner earnings formula, showed something far more powerful. He saw a business that, after accounting for all its true cash expenses and the minimal investment needed to maintain its competitive position, was gushing cash far in excess of its reported profit. That $30 million asking price, which seemed so high relative to the book value and net income, suddenly looked incredibly cheap when compared to this torrent of real spendable owners' cash. Berkshire Hathaway bought See's Candies for $25 million after some negotiation. In the years that followed, that little candy company, which had reported just $2 million in net income, would go on to generate over $2 billion in cash for Berkshire Hathaway, cash that was sent to Omaha to be redeployed into other investments. It required virtually no additional capital investment from Buffett. See's became the prototype for the perfect Buffett business, a cash-printing machine that conventional accounting metrics completely misunderstood. It was the foundational anecdote that proved to him, beyond any doubt, that net income was a liar and that a true investor had to dig deeper to find the truth. This story reveals a powerful psychological principle at play, a cognitive bias that traps the vast majority of investors, the anchoring bias. The human brain is a funny thing. It latches onto the first piece of information it receives and uses it as a reference point for all subsequent judgments. In investing, the first piece of information we are almost always given is the earnings per share, or EPS. It's the headline number. Company X beats earnings by 2 cents. Company Y misses estimates, stock plummets. This single, highly flawed number becomes the anchor. we anchor our valuation to it, calculating price-to-earnings ratios. We anchor our perception of the company's health to it. We anchor our emotional reaction, greed or fear, to its quarterly fluctuations. Buffett's genius is his ability to consciously and systematically sever this anchor. He refuses to let the accountant's opinion be his starting point. His mind immediately discards the reported net income as unreliable noise and begins its own independent inquiry, starting from a place of radical skepticism. He asks, what is the reality here? Not, what does the report say? The anchoring bias is so potent because it simplifies a complex world. It's much easier to look at a single P/E ratio than to read a 100-page annual report and attempt to calculate a company's true underlying cash-generating power. The market craves simplicity, and the EPS figure provides it. This creates a massive opportunity for the disciplined investor who is willing to do the work. While everyone else is arguing about whether a company that earned $1 per share is worth $15 or $20, the Buffett-style thinker is asking whether that dollar of reported earnings is even real. Does it represent a dollar of cash that can be returned to owners, or is it a phantom profit that will be immediately consumed by the voracious appetite of capital expenditures just to stay in business? By refusing to anchor to the convenient fiction of net income, the investor frees themselves to perceive the hidden reality that sees candies so perfectly embodied. A business whose economic value was completely disconnected from its accounting representation. This is a core tenet of any successful investment strategy. You must do your own thinking, and that thinking must begin by questioning the very first number you are given. So how do we translate this insight into a practical tool, a mental model that we can apply to our own investment decisions? Let's build the blueprint for deconstructing the illusion of net income. This is the first step in our journey toward financial literacy and a CEO mindset. Step 1. Locate your target. Pick any public company you're interested in and pull up its most recent annual report, the 10K. Don't use a summary from a financial website. Go to the source. The truth is often buried in the footnotes. Find the consolidated statement of operations, also known as the income statement. Go all the way to the bottom. There it is, net income, or net earnings. This is the anchor. For a moment, acknowledge it. This is the number that the media will report, the number analysts will build their models around. Step 2. Begin the interrogation. Now work your way up from the bottom of that statement. You will see a line item called Provision for Income Taxes. This is the first major point of divergence. The taxes a company reports on its income statement are often wildly different from the actual cash taxes it pays to the government in that same year, due to all sorts of deferrals and accounting rules. The real cash tax paid is found on the cash flow statement. Make a mental note: the tax expense is an estimate, not a cash payment. Step 3. Find the non-cash expenses. Continue moving up the income statement. You will find line items like depreciation and amortization. This is the big one. This is an expense that was subtracted to arrive at that net income number, but no cash actually left the building. The company didn't write a check to Mr. Depreciation. It's an accountant's best guess at how much the company's assets wore out during the year. This is a huge clue. It tells us that the actual cash generated by the operations was much higher than the reported net income. For a company with a lot of physical assets, like a railroad or a manufacturer, this number can be enormous. Step 4. Hunt for other fictions. Scan the rest of the income statement and the accompanying notes for other large, non-cash or one-time items. Did the company take a big impairment charge or a restructuring charge? These are often massive expenses that reduce net income to zero or even create a loss, but they don't represent the underlying, ongoing cash-generating power of the business. Conversely, were there one-time gains, like the sale of a factory, that artificially boosted net income? The goal here is not to become an accountant, but to become a skeptic. You are training your brain to see that the final net income number is a blend of real cash operations and a whole host of accounting judgments. By following these steps, you are no longer passively accepting the anchor, you are actively dismantling it. You are beginning the process of fundamental analysis from first principles. You're not taking the final number as truth, you're seeing it as a heavily edited summary that requires intense scrutiny. This simple process of reading the income statement backwards from a place of skepticism is the first habit you must cultivate. It breaks the spell of the anchoring bias and prepares your mind for the much more powerful calculation of owner earnings. You are starting to see the business not through the eyes of a reporter looking for a headline, but through the eyes of an owner who only cares about the cash. To fully appreciate the wisdom of this approach, we must spend a moment examining its opposite, the antithesis, the path of the 99%. This is the path most retail investors and even many professionals tread. It's a path paved with convenience, emotion, and ultimately financial disappointment. The 99% don't see net income as an anchor. They see it as a destination. Their entire investment strategy revolves around this single, flawed metric. Their process begins and ends with the quarterly earnings report. Days before the announcement, a feverish anxiety builds. Analysts publish their estimates, and the game becomes about one thing: the beat or the miss. When the company reports its earnings per share, the reaction is instantaneous and binary. If the number is a penny higher than the estimate, the stock price surges in pre-market trading. Algorithms fire, headlines are written, and a wave of buying ensues. If the number is a penny lower, the reverse happens. The stock is punished, often falling 10 or 20% in a matter of minutes. The investor on this path is not an owner, they are a gambler betting on a number. They have outsourced their thinking to Wall Street analysts and their emotional state to the millisecond reactions of the market. They don't read the 10K. They don't know the difference between reported taxes and cash taxes. They see depreciation as just another line of accounting jargon. They are completely oblivious to the underlying river of cash, or the lack thereof. They might buy a company that beats earnings estimates by a wide margin, celebrating their genius, without realizing that the company had to spend twice its reported profit on new equipment just to stand still, meaning it actually suffered a massive cash loss. Conversely, they might sell a wonderful business in a panic because it missed earnings due to a one-time non-cash restructuring charge, even though its underlying cash generation remains stronger than ever. This obsession with the earnings game leads to a frantic, short-term focus. Portfolio growth is not seen as the result of owning great businesses for long periods, but as a series of successful bets on quarterly reports. This path encourages trading, not investing. It generates commissions for brokers and anxiety for the individual. It's a classic example of what Charlie Munger calls physics envy, the desire to boil a complex dynamic system like a business down to a single, elegant number like EPS, the way a physicist can describe motion with a simple equation. But a business is not a physics problem. It's a messy, living organism. And treating it like a simple number is the surest way to misunderstand it and, ultimately, to overpay for it or sell it at the worst possible time. The path of the 99% is a frantic sprint on a hamster wheel, powered by the illusion of net income. The path of the owner is a steady, deliberate walk up a mountain, guided by the reality of cash. The financial consequences of this distinction are not academic. They are real, tangible, and they manifest directly in your brokerage account. This is the direct financial connection between understanding the fiction of net income and achieving long-term wealth. Let's consider two hypothetical companies, both trading for the exact same stock price. Company A, Accounting Aces, and Company B, Business Builders. Accounting Aces is a master of financial reporting. This year, they reported a sparkling net income of $1 billion. Their earnings per share were $5, giving them a P/E ratio of 20, which the market deems reasonable. The stock is a darling of financial news. But we, armed with our newfound skepticism, dig into their 10K. We discover that their depreciation charge was $500 million. However, looking at their cash flow statement, we see they spent a whopping $1.5 billion on capital expenditures, new factories, new equipment, new technology. When we talk to people in the industry, we learn that this level of spending is not for massive expansion. It's just the cost of staying relevant in a brutally competitive, technologically fast-moving industry. Their equipment becomes obsolete quickly. In reality, this company didn't generate any cash for its owners this year. In fact, it had to borrow money or issue new stock just to cover the $500 million cash shortfall between its reported profit and its real-world capital needs. The $1 billion profit was a complete mirage. Now look at business builders. They also reported a net income of $1 billion and have the same $5 EPS and PE ratio of 20. On the surface, they look identical to accounting aces, but their story is different. We look at their 10K and see their depreciation charge was also $500 million. But when we look at their capital expenditures on the cash flow statement, we see they only spent $200 million. Their business is durable, their brand is strong. They don't need to constantly reinvent the wheel. Their machinery lasts for decades. This means that after accounting for the cash needed to maintain their operations, business builders generated $800 million in real, spendable cash for its owners. For years, the market might treat these two companies the same because it is anchored to the identical reported net income. But eventually reality always wins. Accounting aces will have to keep borrowing money, diluting its shareholders by issuing new stock, and will struggle to ever return cash through dividends or buybacks. Its stock price will stagnate or fall as the market slowly awakens to the fact that its profits are a phantom. Business builders, on the other hand, will use its $800 million of annual free cash to buy back its own stock, pay a growing dividend, or acquire other cash-generating businesses. Its intrinsic value will compound relentlessly, year after year, and one day the market will recognize the difference and the stock price will follow the value. An investor who bought both might see one stock go nowhere for a decade, while the other becomes a 10-bagger. The difference was not luck. It was the ability to see from day one that $1 billion of net income is not always $1 billion of net income. This is the financial power you unlock when you learn to ignore the story and find the truth. Having established the fundamental unreliability of net income, we now arrive at the core of our analysis, the solution. If the accountant's number is a fiction, what is the number that represents the truth? Warren Buffett provided the answer in his 1986 letter to Berkshire Hathaway shareholders, a document that has since become a sacred text for serious investors. In it, he laid out, with characteristic clarity and simplicity, his preferred metric for judging a company's economic performance. He called it owner earnings. This wasn't just another piece of financial jargon, it was a revolution in thinking. It was a formula designed to answer that one simple, powerful question: how much cash is really left over for the owners? The foundational anecdote for this pillar is not a dramatic takeover battle or a shrewd market call. It's the quiet, intellectual act of Buffett himself sitting down to write that 1986 letter. Imagine the context. By the mid-1980s, Berkshire Hathaway was already a formidable company. Buffett's track record was the stuff of legend. But a dangerous trend was sweeping through corporate America and Wall Street: the rise of what he called the deconglomerateur and the leveraged buyout artists. These financiers were using mountains of debt to acquire companies, and to justify their actions, they were popularizing new, misleading metrics of performance. They encouraged investors and executives to ignore net income, which was often wiped out by the huge interest payments on their debt, and to instead focus on things like cash flow or EBITDA, earnings before interest, taxes, depreciation, and amortization. They argued these were better measures of a business's health. Buffett saw this for what it was: an intellectual sleight of hand. He knew that a business that doesn't pay taxes or interest won't be a business for long. And most critically, he knew that ignoring depreciation and amortization was a cardinal sin. These so-called non-cash charges were stand-ins for a very real cash expense that every business with physical assets must eventually pay: capital expenditures, the money spent on property, plant, and equipment. To ignore this was to pretend that a factory never wears out, that a delivery truck runs forever, that technology never needs updating. It was, in his words, a pernicious practice that makes an absurdity of the cash flow numbers that are often presented. So in his letter, he decided to provide a clear, unambiguous alternative. He wasn't just critiquing, he was building a better tool. He sat at his desk in Omaha, not to impress academics or analysts with a complex formula, but to explain to his partners, the everyday shareholders of Berkshire, how he and Charlie Munger thought about the businesses they owned. He wrote, and this is the genesis of it all, if we think through the characteristics of a business, we can come up with a sensible calculation for owner earnings. These represent A. Reported earnings plus B. Depreciation, depletion, amortization, and certain other non-cash charges, less C. The average annual amount of capitalized expenditures for plant and equipment, etc., that the business requires to maintain its long-term competitive position and its unit volume. Let's break that down. He starts with net income, the number from the bottom of the income statement. He acknowledges it's the starting point. Then, he adds back the big non-cash expenses, primarily depreciation and amortization. This first step is similar to how one calculates traditional cash flow. It recognizes that these accounting charges didn't actually drain cash from the business during the year. This gives you a rough proxy for the cash the business's operations brought in the door. But it is the third step, Part C, that is the stroke of pure genius and the key differentiator. He then subtracts an estimate for what he calls maintenance capital expenditures. This is the crucial, often ignored piece of the puzzle. This isn't the total amount the company spent on new equipment that year. It's the specific amount of spending required just to tread water, just to maintain the company's current level of sales and its competitive moat. By crafting this definition, Buffett was making a profound statement. He was declaring that the only profit that matters to an owner is the profit left over, ensuring the long-term health and viability of the enterprise. A company that reports $1 billion in profit but had to spend $1 billion on replacing its worn-out machinery has, in reality, earned nothing for its owners. It's a business running to stand still. The owner earnings formula ruthlessly exposes this reality. This letter was not just a piece of financial disclosure, it was a manifesto. It was a direct assault on the flawed mental models of Wall Street, and a gift of clarity to any retail investor willing to listen. It was the formalization of the very thinking that led him to buy See's Candies over a decade earlier. It was the secret recipe, published for all the world to see. The reason this simple formula is so powerful and yet so rarely used by the masses comes down to an underlying psychological principle, complexity bias. Our brains have a built-in tendency to believe that complex solutions are better than simple ones. We see a hedge fund manager with 10 computer screens running complex algorithms, and we assume they must be smarter and more effective than someone sitting quietly in a room reading an annual report. We hear a CEO use convoluted jargon and talk about sophisticated financial engineering, and we are intimidated into thinking they have a level of understanding we can't possibly match. Accounting itself is a system of immense complexity, with thousands of pages of rules and regulations. The average person assumes that the output of such a complex system, the net income number, must be the most accurate and sophisticated measure possible. Buffett's owner earnings formula is an act of rebellion against this bias. It is radically simple: net income plus depreciation minus maintenance capex. A person with a basic understanding of a financial statement can calculate it. This simplicity is its strength, but it's also why so many people dismiss it. It feels too easy. Surely valuing a multi-billion-dollar corporation requires something more arcane, more difficult? The complexity bias leads investors down a rabbit hole of ever more complicated valuation models, discounted cash flow analyses with dozens of variables projected out 10 years, and a reliance on obscure metrics. They believe that by adding more complexity they are adding more precision. In reality, they are often just adding more opportunities to be wrong. Buffett understands that in investing, the goal is not to be precisely wrong, but to be approximately right. His formula cuts through the fog of accounting complexity to isolate the few variables that truly matter. It ignores the 100 things that don't matter and focuses with laser intensity on the one thing that does: cash available to owners. Overcoming the complexity bias is a crucial step in developing a true CEO mindset. A great CEO, like a great investor, is a master of simplification. They can take 1,000 competing priorities and identify the one or two that will truly move the needle. The owner earnings formula does the same for financial analysis. It is a tool of profound intellectual honesty, and its simplicity is a feature, not a bug. It forces you to confront the brutal reality of a business's economics, without the comforting, complex fictions of standard accounting. Now let's translate this theory into practice. This is the blueprint for calculating owner earnings for any company you wish to analyze. This is the core of the Warren Buffett method for stock picking. Step 1. Gather your materials. You will need the company's most recent 10K, specifically the income statement and the cash flow statement. Let's get the easy numbers first. From the income statement, find the net income line. Write that number down. From the cash flow statement, in the cash flow from operations section, find the depreciation and amortization line. Write that number down. The first part of our calculation is simple: net income plus depreciation and amortization. This gives us a rough measure of the cash generated by the business. Step 2. The investigator's challenge: finding capital expenditures. Still on the cash flow statement, look for the cash flow from investing section. In this section, you will find a line item that says something like purchases of property, plant, and equipment, or capital expenditures. This number is usually shown as a negative because it represents cash leaving the company. This is the total amount the company spent on PP&E in a given year. Write this number down. Now you have the total CapEx, but remember, Buffett's formula requires us to subtract only times maintenance times CapEx, not total CapEx. This is the single hardest and most important part of the calculation. Step 3. Estimating maintenance CapEx. A company doesn't break this number out for you. You have to be a detective. There are several good methods to get a reasonable estimate. Method A, the simple average. For a mature, slow-growing company, a good starting point is to assume that over the long run, maintenance CapEx will be roughly equal to the annual depreciation charge. The logic is that depreciation is the accounting estimate of how much assets wear out, so the cash needed to replace them should be similar over a full business cycle. So for a first pass, you can simply use the depreciation number as your proxy for maintenance CapEx. Method B, the Bruce Greenwald method. For a company that is growing, this is more precise. Professor Bruce Greenwald of Columbia Business School developed a brilliant technique. First, you calculate the company's average gross property, plant, and equipment, PP&E, to sales ratio over the past 5 years. Then, you look at the increase in sales for the current year. You multiply that sales increase by the PP&E to sales ratio to estimate how much CapEx was spent on asterisk growth. You then subtract this growth CapEx number from the total CapEx figure you found in Step 2. The remainder is your estimate for maintenance CapEx. This method requires a bit more work with a spreadsheet, but gives a much more nuanced and accurate result. Step 4, the final calculation. You now have all the pieces. Take your number from Step 1, net income plus D&A, and subtract your estimate of maintenance CapEx from Step 3. The result is your owner earnings. This number represents the true, discretionary cash profit the business generated for the year. This is the number you should use as the E in your price-to-earnings analysis. Comparing the P/E ratio to the price-to-owner earnings ratio will often reveal a startlingly different picture of a company's valuation. This is the fundamental analysis that separates you from 99% of other investors. The failure to perform this kind of rigorous analysis defines the antithesis, the path of the 99%. Most investors, even many so-called professionals, commit a fatal error of intellectual laziness. They accept the numbers they are given without question. Specifically, they use flawed substitutes for true owner earnings, metrics that are popular precisely because they are easy to calculate and make businesses look better than they really are. The most common and dangerous substitute is EBITDA, earnings before interest, taxes, depreciation, and amortization. This metric became wildly popular during the dot-com boom and the age of private equity because it paints a rosy picture of a company's profitability. By adding back depreciation, it makes earnings look much larger. The argument is that depreciation is a non-cash charge, which is true, but the conclusion they draw that it should therefore be ignored is a lie. As we've discussed, depreciation is a proxy for the very real cash expense of maintenance capex. As Charlie Munger has colorfully said, I think that every time you see the word EBITDA, you should substitute the words bullshit earnings. The 99% use EBITDA because it's simple and it makes the numbers look big. It allows them to justify paying absurd prices for companies, especially those in capital-intensive industries. They convince themselves a company is cheap on a price-to-EBITDA basis, ignoring the fact that the entire EBITDA might be consumed by the need to replace aging equipment. Another flawed substitute is simple free cash flow, FCF. Free cash flow is typically calculated as cash flow from operations minus total capital expenditures. This is a huge step up from EBITDA or net income, as it at least accounts for cash spending on assets. However, it still falls short of the precision of owner earnings. By subtracting total capex, FCF penalizes companies that are investing heavily for profitable future growth. A company might spend a huge amount on a new factory that will double its profits in 2 years. Under the standard FCF calculation, this company would look terrible for the year of the investment, showing low or even negative free cash flow. Buffett's owner earnings calculation, by contrast, would only subtract the maintenance portion of that spending. It would recognize the difference between money spent to stand still and money spent to grow. The path of the 99% is to use these convenient but flawed metrics, leading them to either overvalue capital-intensive businesses using EBITDA or undervalue growing businesses using standard FCF. Only the rigorous estimation of maintenance capex allows an investor to see the true picture, a task most are unwilling to undertake. The direct financial connection here is the profound impact this calculation has on your perception of value. It literally changes which stocks appear cheap and which appear expensive, directly influencing your stock picking and, therefore, your long-term portfolio growth. Let's imagine 2 companies in the same industry, both trading for a market capitalization of $1 billion. Company X has a net income of $100 million, giving it a PE ratio of 10. Company Y has a net income of $80 million, giving it a PE ratio of 12.5. Following the path of the 99%, an investor would conclude that Company X is 25% cheaper than Company Y. It seems like the obvious choice. Now let's apply the CEO mindset and calculate owner earnings. We dig into the financials. For Company X, we find that its depreciation charge is $50 million, but its maintenance capital expenditure needs are a staggering $120 million per year. It's in a tough business with rapidly aging assets. Its owner earnings are 100M net income plus 50M D&A, 120M maintenance capex equals $30 million. The company's price-to-owner earnings ratio is 1,030 million, which is over 33. For Company Y, we find its depreciation charge is $40 million, and its maintenance capex needs are only $20 million per year. It has a more durable business model. Its owner earnings are 80M net income plus 40M D&A, 20M maintenance capex equals $100 million. The company's price-to-owner earnings ratio is 1 billion/100 million, which is 10. The results are a complete inversion of reality. Company X, which looked 25% cheaper based on standard metrics, is actually more than 3 times as expensive as Company Y when viewed through the lens of an owner. The investor who bought Company X based on its low PE ratio has fallen into a classic value trap. They bought a business that is consuming cash, not generating it. The investor who did the work and bought Company Y has acquired a genuine cash printing machine at a very reasonable price. Over the next decade, Company Y will use its massive owner earnings to reward shareholders, while Company X will struggle just to survive. The difference in the financial outcome for these two investors will not be marginal, it will be monumental. This is how fortunes are built, not by finding what looks cheap, but by understanding what is cheap. And that understanding is impossible without the tool of owner earnings. The third pillar of our deep dive into Warren Buffett's method is perhaps the most misunderstood and criminally overlooked aspect of financial analysis: the menace of capital expenditures. We've established that the key difference between Buffett's owner earnings and almost every other profitability metric is its intelligent handling of CapEx. But to truly master this concept and deploy it as part of a winning investment strategy, we need to go deeper. We must dissect the nature of CapEx itself, understanding that not all spending is created equal. There is a world of difference between money spent to grow and money spent just to survive, and the inability of conventional accounting and most investors to distinguish between the two is a source of constant, massive error in stock valuation. For the foundational anecdote that brings this principle to life, we must look to one of Buffett's largest and most defining acquisitions, the purchase of the Burlington Northern Santa Fe (BNSF) Railroad in 2009. This was an all-in bet on America, a $34 billion acquisition that was, at the time, the largest in Berkshire Hathaway's history. To the outside world, it seemed like a strange move for a man famous for buying capital-light businesses like See's Candies and Coca-Cola. Railroads are the exact opposite. They are monstrously capital-intensive. They are a never-ending cycle of spending vast sums of money on laying track, maintaining bridges, and buying locomotives that cost millions of dollars apiece. On the surface, a railroad's financial statements can look terrifying. The net income is often dwarfed by the colossal line item for capital expenditures. If you were to use a simplistic free cash flow calculation, operating cash flow minus all CapEx, a railroad would often look like a terrible business, barely generating any cash at all. And this is precisely why Wall Street has historically had a love-hate relationship with the industry, often assigning it low valuation multiples. But Buffett, looking at BNSF, saw a completely different reality. He wasn't scared by the headline CapEx number. He was intrigued by it. His entire analysis hinged on his ability to intelligently dissect that spending. He understood that a significant portion of BNSF's multi-billion-dollar annual CapEx budget was not maintenance CapEx in the truest sense. Yes, a large chunk was spent on replacing worn-out track and aging locomotives, the true cost of treading water. This was the maintenance portion he would subtract in his owner earnings calculation, but a huge additional amount was being spent on what he would classify as quote CapEx. This was money spent on laying a second line of track next to a busy existing line to increase capacity. It was money spent on building new terminals to serve the booming energy fields of the Bakken Shale. It was investment in new technology to make the trains longer, faster, and more fuel-efficient. Each of these growth projects was, in essence, a separate, high-return business decision. The investment in double-tracking a line might cost $1 billion, but it could allow the railroad to take on so much more traffic that it would generate an additional $150 million in profit each year, a solid 15% return on that incremental investment. Buffett knew that the railroad had a durable competitive advantage. You simply cannot build a competing rail network across the United States. The rights of way and capital costs are insurmountable. This moat meant that BNSF could reinvest its cash into its own network at attractive rates of return for decades to come. The average analyst looking at the huge total CapEx number saw a cash-hungry monster. They failed to make the critical distinction. Buffett, using his owner earnings framework, mentally split the capex into two buckets. He subtracted the maintenance portion to find the company's baseline profitability, which was substantial and well protected. Then he looked at the growth portion and analyzed it not as a cost but as a series of new investments. He was essentially buying a solid, cash-generative core business that also came with a portfolio of high-return internal growth opportunities. The $34 billion price tag, which seemed high to some, was a bargain when you understood that you were buying not just the current earning stream, but a compounding machine with a clear, protected path to reinvesting those earnings for future growth. The BNSF acquisition is the ultimate testament to the power of seeing capex not as a monolithic evil, but as a nuanced reality that must be understood from the CEO mindset of an owner. The chronic inability of the market to make this distinction is rooted in a pair of powerful psychological principles: the action bias and the sunk cost fallacy. The action bias describes our innate tendency to favor action over inaction, even when inaction is the more rational course. In the corporate world, this manifests as a deep-seated belief among CEOs that they must always be doing something to grow the company. Announcing a massive new factory, a bold expansion into a new country, or a huge technology upgrade are all seen as signs of a dynamic, forward-thinking leader. It's much harder for a CEO to go to their board and say, "We have no good investment opportunities this year, so we are going to do nothing and just return all the cash to shareholders." The bias is towards spending, towards action. This often leads to diversification, where companies spend their owner earnings on ill-conceived projects outside their circle of competence, simply for the sake of looking busy and growing the empire. This is compounded by the sunk cost fallacy, our tendency to continue an endeavor once an investment of money, effort, or time has been made. Imagine a CEO who champions a billion-dollar project to build a new plant. Halfway through, it becomes clear that market conditions have changed, and the returns from this plant will be terrible. The rational decision would be to cut their losses and stop, but the sunk cost of the $500 million already spent creates a powerful psychological pressure to continue. "We can't stop now, we've already spent so much," they'll say. This leads to throwing good money after bad, destroying shareholder capital in the process. Buffett's framework for analyzing capital expenditures is a powerful antidote to both biases. By first calculating owner earnings before Twiner's growth capex, he establishes a clear baseline of the company's true profitability. This separates the core business from the CEO's expansionary ambitions. He can then analyze each growth project on its own merits, asking a simple, brutal question: is the expected return on this new investment greater than what I could get by buying other stocks in the market? This disciplined approach forces a rational capital allocation decision. It protects him from falling for a CEO's empire-building ambitions, action bias, and allows him to unemotionally assess whether new spending is creating or destroying value, regardless of what has been spent in the past. Sunk cost fallacy. He acts as the ultimate rational capital allocator, a role that most investors and even most CEOs are psychologically ill-equipped to play. So how do we, as retail investors, apply this sophisticated mental model? How do we build the blueprint for intelligently analyzing a company's capital spending? It requires us to go beyond the numbers on the cash flow statement and become true business analysts. Step 1. Calculate the capex to sales ratio. For the company you are studying, look up its total capital expenditures and its total sales for each of the last 5 to 7 years. For each year, divide the capex by the sales. This gives you a ratio that shows how much the company has to spend on assets to generate $1 of sales. Is this ratio stable, rising, or falling? A rising ratio is a red flag. It suggests the business is becoming more capital-intensive, and it will require more and more cash just to maintain its sales level. This is a key part of any serious financial statement analysis. Step 2. Compare capex to depreciation. As we discussed, for a no-growth company, Total CapEx should roughly equal depreciation over a cycle. Create a simple chart tracking both numbers over the past decade. If CapEx is consistently and significantly higher than depreciation, you must ask why. This leads to two possible conclusions. Either the company's assets are wearing out faster than the depreciation schedule suggests, which means the reported earnings are overstated, or the company is investing heavily in growth. Your job is to figure out which it is. Step 3. The growth investigation. To determine if the excess spending is for profitable growth, you must read the Management's Discussion and Analysis (MD&A) section of the 10K. This is where the company's executives are required to explain their results and strategy. Look for any discussion of major capital projects. Are they building a new factory? Why? What do they expect it to produce? Are they upgrading their technology? What is the expected benefit? You must also look at the company's return on invested capital, ROIC. If a company is spending heavily on growth, but its ROIC is consistently falling, that is a massive warning sign. It suggests they are pouring money into projects that are generating poor returns, destroying shareholder value. A company like BNSF, however, was able to maintain high returns on its incremental investments. Step 4. Classify the business. Based on this investigation, you can now classify the business into one of three categories. Is it a See's Candies type business that requires very little CapEx and gushes cash? Is it a BNSF type business that requires heavy CapEx, but much of that spending is for high-return growth projects? Or is it a value trap business that requires enormous CapEx just to stand still, consuming all of its reported profits in the process? Your executive decision-making on whether to invest and at what price will be vastly different for each of these categories. This is the kind of deep, fundamental analysis that is the hallmark of the Warren Buffett method. This rigorous work stands in stark contrast to the path of the 99%. The antithesis here is the widespread celebration of growth at any cost. The average investor, swept up in a story, loves to see a company announce massive spending plans. They see it as a sign of ambition and future success. They cheer when a company announces it will build the world's largest factory or enter a dozen new markets at once. They don't stop to ask the crucial second-level question, what is the likely return on that capital? Take the cautionary tale of the fiber optic boom in the late 1990s. Companies like WorldCom and Global Crossing announced they were spending tens of billions of dollars to lay a global network of fiber optic cables. The market went wild. The story was compelling, the internet was growing, and it would need this data superhighway. Investors poured money into these stocks, mesmerized by the sheer scale of the capital expenditures. They saw the spending itself as proof of future dominance. They failed to do the math. The amount of capacity being built was so astronomically larger than any reasonable projection of demand that it was a virtual certainty the price for using that capacity would plummet to near zero. They were spending billions to build assets that would never earn a decent return. It was growth for the sake of growth, a classic case of the action bias run amok on an industry-wide scale. The investors who cheered this spending were not thinking like owners. An owner would have asked, if we spend this $30 billion, how much cash profit will it generate for us each year, and how does that compare to our other options? The speculators of the dot-com bubble only asked, how big is the story? When the inevitable crash came, these companies went bankrupt, and trillions of dollars of shareholder wealth were vaporized. They had mistaken the expenditure of cash for the creation of value. It is one of the most common and devastating mistakes in investing, and it stems directly from a failure to intelligently analyze capital expenditures. The direct financial connection of mastering this pillar is the ability it gives you to protect your portfolio from capital destruction and align it with true capital creation. When you can successfully differentiate between maintenance and growth CapEx, you can build a portfolio that benefits from two powerful forces. First, you can identify the truly wonderful capital-light businesses that the market may not fully appreciate. A company that has low-maintenance CapEx needs can return almost all of its earnings to shareholders through buybacks and dividends, which directly fuel portfolio growth. Or it can use that cash to make intelligent bolt-on acquisitions. These are the golden geese, and they are often hiding in plain sight, dismissed as boring by those chasing exciting stories. Second, you can confidently invest in capital-intensive businesses when, and only when, they have a proven ability to reinvest that capital at high rates of return within a durable competitive moat, like BNSF. You will not be scared away by the large headline CapEx number because you understand its true nature. This allows you to buy wonderful, growing businesses at reasonable prices, while other investors who use simplistic metrics are scared away. Imagine your portfolio over 20 years. If it is filled with companies that consistently spend more on maintenance CapEx than they report in depreciation, your reported earnings are an illusion. The real value of your holdings is slowly eroding, even if the stock prices are treading water. Your wealth is being silently destroyed by the hidden cost of staying in business. But if your portfolio is filled with a mix of capital-light cash gushers and disciplined, high-return capital allocators, you have a powerful engine for compounding wealth. The cash generated by your companies is being used to make your ownership stake more valuable every single year. The difference is not just in the numbers. It's the difference between a portfolio built on a foundation of sand and one built on a foundation of solid rock. This is the financial peace of mind that comes from adopting the CEO mindset and truly understanding where the money goes. We have now journeyed from the fiction of net income to the reality of owner earnings and through the critical landscape of capital expenditures. This brings us to our fourth pillar, the establishment of the cash flow kingdom. In the world of business valuation, there are many contenders for the throne, many metrics that analysts and investors champion as the ultimate measure of a company's worth. We've touched on some already, like net income and EBITDA. But to solidify your financial literacy, we must explicitly demonstrate why owner earnings is the rightful king, a superior proxy for long-term value creation compared to all its rivals. It is the most honest, most owner-oriented, and ultimately most useful metric for any investor seeking to beat the market. The perfect foundational anecdote to illustrate the supremacy of cash flow is Buffett's legendary investment in the Coca-Cola Company. In 1988, after a long period of avoiding the stock market, which he felt was overvalued, Buffett made a dramatic move. Over a period of several months, Berkshire Hathaway invested over $1 billion to acquire a roughly 6% stake in Coca-Cola. At the time, this was a massive bet, even for him. To many on Wall Street, it seemed bizarre. Coca-Cola was not a beaten-down, statistically cheap stock in the Ben Graham mold. It was one of the largest, most well-known companies in the world. It was trading at a P/E ratio that was higher than the market average. What did Buffett see that others were missing? He saw a business that was the absolute epitome of an owner earnings champion. He wasn't focused on the quarterly earnings or the P/E ratio. He was focused on the unbelievable economics of the business, economics that were perfectly captured by his mental framework. First, consider the product. It was a simple sugar water syrup. The cost to produce it was minuscule. The capital required to maintain the syrup-making plants was laughably small relative to the sales they generated. This meant maintenance CapEx was a tiny, insignificant drag on the torrent of cash the business produced. Second, and most brilliantly, the company had outsourced most of the capital-intensive parts of the business to others. Coca-Cola itself didn't own the bottling plants around the world. It didn't own the massive fleets of delivery trucks. It didn't own the vending machines or the fountain dispensers in restaurants. Its franchisees and partners, the bottlers, bore those enormous capital costs. Coca-Cola's primary role was to sell the syrup concentrate to the bottlers and, most importantly, to nurture the brand. Its main expenditure was on advertising, which is expensed immediately on the income statement, meaning the reported net income was likely understating the true economic reality, as the benefit of that advertising spend would last for years, creating a powerful brand asset that didn't appear on the balance sheet. So when Buffett looked at Coca-Cola, he saw a business with staggering returns on tangible capital. It was a royalty on the thirst of humanity. It required almost no incremental capital to grow. If people in a new country wanted to drink Coke, the local bottler would build the plant and buy the trucks. Coca-Cola just had to ship them more syrup and collect the cash. This was the ultimate capital-light business model. The reported net income was huge, but the owner earnings were even more spectacular because the maintenance capex deduction was so tiny. The company was a fire hose of cash that could be used to pay dividends and buy back stock, relentlessly increasing the value of the remaining shares. Buffett's $1 billion investment in 1988 would, through stock splits and reinvested dividends, become worth well over $10 billion in the following decades, representing one of the greatest investment decisions in history. The genius of the investment was not in finding an obscure company, but in appreciating the true economic engine of a famous one. While others were debating whether a PE of 15 was too high, Buffett was calculating the phenomenal owner earnings yield and realizing that he was buying a perpetual compounding machine at a fair price. He chose to rein in the cash flow kingdom, and it paid off spectacularly. The Coca-Cola story is the ultimate proof that the quality of the earnings, measured by their conversion into owner cash, is far more important than the quantity of earnings reported by accountants. The reason so many investors fail to grasp this, preferring metrics like EBITDA, is due to the powerful psychological principle of herd mentality, also known as social proof. Humans are social creatures. We are wired to feel safe in a crowd and to take our cues from what others are doing. If everyone around us is running in one direction, our instinct is to run with them, not to stop and ask why. In investing, this manifests as a reliance on conventional wisdom and popular metrics. For the last few decades, particularly in the world of private equity and high-growth tech, EBITDA has been the metric of the herd. Analysts talk about it, companies report adjusted EBITDA in their press releases, and bankers use it for their valuation models. It's everywhere. To reject EBITDA and insist on using a less common metric like owner earnings is an act of social defiance. It requires independent thought and the courage to stand apart from the crowd. It means you will look at a company the herd considers a great buy, and you might see a cash-burning trap. Conversely, you might see a wonderful opportunity in a company the herd is ignoring because its reported numbers look messy. The pressure to conform is immense. When a stock you own is going down and everyone is pointing to its disappointing EBITDA, it is psychologically difficult to hold on, even if your own owner earnings analysis shows the business is fundamentally sound. Buffett is the master of resisting the herd. He famously said, "Be fearful when others are greedy and greedy when others are fearful." This is not just a catchy phrase, it's a description of his psychological fortitude. His owner earnings framework is his analytical anchor in a sea of social pressure. It allows him to ignore the noise and the chatter of the crowd and focus only on the economic reality of the business. When you adopt owner earnings as your primary valuation tool, you are consciously choosing to step away from the herd. You are building a system that forces you to think for yourself. This is an essential component of any investment strategy designed for beating the market. The market times the herd. You cannot achieve superior results by doing what everyone else is doing and using the same flawed tools they are using. Let's build the blueprint for making owner earnings the king of your analytical process. This involves not just calculating the number, but learning how to use it to compare companies and make better executive decisions. Step 1. Calculate owner earnings. You've already mastered this. For any company you analyze, perform the full calculation: net income plus D&A, estimated maintenance capex. This is your new baseline E for earnings. Step 2. Calculate competing metrics. For the same company, now calculate the other numbers the herd uses. Find the net income. Calculate the EBITDA, which is usually found by taking operating income and adding back D&A. And calculate the standard free cash flow, operating cash flow total capex. Step 3. The comparative analysis. Now, create a simple table with these four numbers side by side: net income, EBITDA, free cash flow, and owner earnings. This is where the insights happen. For a capital-intensive company like a steel mill, you will see a massive EBITDA figure, a much smaller net income, and likely a tiny or negative free cash flow and owner earnings number. The table will instantly show you how misleading EBITDA is. For a growing software company, you might see a low net income due to heavy R&D spending, a negative free cash flow due to investment in servers for growth, but a healthy and positive owner earnings figure because the maintenance CapEx is low and the growth spending is properly accounted for. Step 4. Create owner yield ratios. The real power comes from turning these numbers into valuation metrics. Divide the company's stock price per share by its earnings per share to get the P/E ratio. But then, divide the stock price by your calculated owner earnings per share. This gives you a price-to-owner earnings POE ratio. This is your true valuation compass. Also, you can invert this to calculate an owner earnings yield. Simply divide owner earnings per share by the stock price. This tells you the real cash return you are getting on your investment each year. A company with a 10% owner earnings yield is like a bond that pays you 10% a year in real cash. This is an incredibly powerful way to think about a stock's value and is central to the Warren Buffett method. By consistently comparing companies on their owner earnings yield, you will train your mind to spot genuine bargains that the rest of the market, obsessed with P/E ratios and EBITDA, completely misses. The antithesis, the path of the 99%, is to blindly chase growth stories without any regard for the cash flow that underpins them. This is the path that leads to speculative bubbles and devastating losses. The poster child for this mentality in the modern era has been the obsession with growth at all costs tech stocks, particularly those that are not yet profitable. Investors on this path fall in love with a narrative, a disruptive technology, a charismatic founder, a massive total addressable market. They justify buying shares in companies with hundreds of millions of dollars in losses by using vanity metrics created by the companies themselves. They don't look at owner earnings. They look at things like monthly active users, gross merchandise volume, or annual recurring revenue. These can be useful data points, but they are not measures of profit. The investor on this path convinces themselves that profitability is just around the corner. Once they reach scale, the argument goes, the profits will be immense. This can sometimes be true, but more often than not, it's a mirage. The competition is fierce, the marketing costs are astronomical, and the capital required to keep growing is endless. These companies burn through cash year after year, funding their losses by selling more stock to new investors, diluting the ownership of the early believers. The path of the 99% is to value these companies based on a dream of future profits. The path of the owner is to demand real, tangible cash profits today. An owner wants to know what cash the business is generating for them now, not what it might generate in a hypothetical future. By ignoring the discipline of the cash flow kingdom, these investors become speculators on a story, not owners of a business. And when the story changes, or the cheap funding dries up, their portfolios are decimated. The landscape of the stock market is littered with the bones of once high-flying companies that had millions of users but never figured out how to generate a dollar of owner earnings. The direct financial connection of crowning cash flow as king in your analysis is the creation of a resilient, self-funding portfolio. A portfolio built on companies with strong and growing owner earnings is a fortress of financial strength. Here's how it manifests in your wealth. First, it dictates how companies can reward you. A company with high owner earnings has options. It can pay a reliable and growing dividend, providing you with a direct cash return on your investment. It can systematically buy back its own shares. A buyback is a powerful, tax-efficient way to increase your ownership percentage of the business, without you having to do anything. If you own 1% of a company, and it buys back half of its outstanding stock over a decade, you now own 2% of a more focused, more profitable enterprise. Your wealth has doubled purely as a result of the company's intelligent use of its owner earnings. Second, it provides a margin of safety during tough times. A company that is gushing cash can survive a recession without having to take on debilitating debt or issue dilutive stock at low prices. A company that is burning cash is at the mercy of the capital markets. When a crisis hits, the cash-rich company can even play offense, buying back its own stock at bargain prices or acquiring struggling competitors. Your portfolio becomes anti-fragile. It actually gets stronger in a crisis. Over the long term, the stock prices of companies will inevitably follow their underlying owner earnings. A company that can double its owner earnings per share over 5 years will almost certainly see its stock price do something similar, assuming the valuation multiple remains constant. By focusing your investment strategy on identifying and owning these cash-generating machines, you are directly tying your financial future to the most reliable and powerful force in business: the relentless power of compounding real cash. Your portfolio growth becomes a function of business reality, not market sentiment. That is the ultimate financial advantage. We have now assembled the core intellectual machinery of our investment engine. We've learned to see through the illusion of net income, we've mastered the formula for owner earnings, we've dissected the menace of capital expenditures, and we've enthroned cash flow as the undisputed king of valuation. This brings us to our fifth and final pillar: application and execution. A powerful tool is useless if it stays in the toolbox. A brilliant strategy is worthless without the discipline to implement it. This final chapter is about translating this entire framework from theory into practice. It is about how to actively use this CEO mindset in your own portfolio, how to read financial statements with a new and predatory focus, and how to make executive decisions on stock picking with the confidence and conviction of an owner, not the hopeful anxiety of a speculator. To find the perfect foundational anecdote for this pillar, we must go back to one of the most dramatic and formative events of Buffett's early career, the Great Salad Oil Scandal of 1963 and its impact on American Express. This story is the ultimate case study in moving beyond the numbers on a page and executing an investment decision with the conviction that only comes from true, ownership-level due diligence. American Express was, at the time, a blue-chip company known primarily for its travelers' checks and credit cards. But it had another, more obscure division that dealt in warehousing. Essentially, companies could store their inventory in Amex warehouses, and Amex would issue a receipt for that inventory, which the company could then use as collateral to get loans. One of its biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. Allied stored vast quantities of salad oil in Amex's warehouses. The problem was, Tino DeAngelis was a fraud. Most of the salad oil didn't exist. He had filled the giant tanks mostly with water, with only a small layer of oil floating on top for inspectors to see. The entire operation was a massive Ponzi scheme. When the fraud was discovered in late 1963, Allied Crude collapsed, defaulting on over $150 million in loans that were backed by the now worthless Amex warehouse receipts. The market panicked. Wall Street assumed that American Express would be on the hook for the entire $150 million. This was a catastrophic sum, an amount that threatened to wipe out the company's entire net worth. The stock price of American Express was cut in half almost overnight. A wave of terror swept through the investment community. Everyone was selling. The financial statements, which would soon have to account for this massive potential liability, looked horrifying. This was a crisis of existence. This is where the 23-year-old Warren Buffett, then running his small partnership in Omaha, stepped in. While the rest of the world was reacting to the headline news and the terrifying numbers, Buffett engaged in an act of pure, ownership-level thinking. He asked a simple question: does this scandal impair the fundamental cash-generating engine of American Express's core businesses? He knew the company made most of its money from travelers' checks and credit cards, so he decided to do his own primary research, what he called scuttlebutt. He didn't just read the reports. He went out into the field. He visited restaurants and banks. He talked to merchants. He would stand at a cashier's counter and observe customers. Were people still using their American Express cards? Were they still buying travelers' checks? He would ask store owners, Are you still accepting the Amex card now, with all this news? He interviewed suppliers. He talked to competitors. The feedback was overwhelmingly positive. The public didn't connect the salad oil warehousing division with the traveler's checks in their pocket. The brand was so powerful, the habit of using the card so ingrained, that the scandal was having virtually zero effect on the company's core operations. The cash registers were still ringing. The owner earnings engine was still humming along, completely untouched by the crisis in the warehousing division. Armed with this on-the-ground knowledge, Buffett concluded that the market's fear was wildly irrational. He determined that even if Amex had to pay the full liability, the powerful, ongoing profitability of its core business would allow it to survive and thrive. He saw a temporary survivable problem that the market was treating as a fatal blow. With immense conviction, he invested 40% of his partnership's assets, a huge, concentrated bet, into American Express stock. Within a few years, the company settled the salad oil claims for a fraction of the feared amount. The market realized the core business was a gold mine, and the stock price soared. Buffett made a fortune for his partners. This story is the pinnacle of execution. It demonstrates that the final step of a great investment decision is not just a calculation, but an investigation. It's about having the courage, based on your own deep analysis, to act decisively when the rest of the world is paralyzed by fear. The psychological principle that allows for this kind of decisive action is the overcoming of overconfidence bias and its cousin, the illusion of control. Most retail investors suffer from these biases in the wrong way. They are overconfident in their ability to predict short-term stock price movements, or to pick the next hot tech stock based on a superficial understanding. They believe they have control over random market noise. This leads to frequent trading and poor results. True mastery of the CEO mindset, however, requires a different kind of confidence, a deep, earned confidence in one's own analytical process. Buffett's confidence in the American Express situation was not arrogance. It was the result of incredibly hard work. He had done more research and had a better understanding of the company's true business reality than the Wall Street analysts who were panicking. He had earned the right to be confident. His circle of competence was not in predicting the stock price tomorrow, but in evaluating the long-term economics of the business. The owner earnings calculation gives you the financial foundation, but the scuttlebutt gives you the conviction to act on it. By building a rigorous, repeatable process for financial statement analysis and business investigation, you systematically reduce the role of luck and increase the role of skill in your investment outcomes. You replace the illusion of control over the market with actual control over your own decision-making process. You are no longer swayed by the market's manic-depressive mood swings, because your feet are planted firmly on the bedrock of your own independent work. This shift from hollow overconfidence to earned conviction is the final psychological transformation from a retail investor into a true business owner. It is the core of a successful, lifelong investment strategy. Let's now build the final blueprint, the owner's audit, a checklist for executing a full analysis of a potential stock investment, bringing together everything we've learned. Step 1. The quantitative gauntlet. Before you do anything else, run the numbers. A. Calculate owner earnings for the past 5 years. Is it positive? Is it growing? Is it stable or volatile? B. Calculate the price-to-owner earnings ratio. Is it reasonable compared to the company's growth prospects and the broader market? C. Calculate the owner earnings yield. Is this a cash return you are happy to receive? D. Analyze the capital expenditures. Is this a capital-light business or a capital-intensive one? If it's intensive, have they historically earned good returns on that invested capital? Check their return on invested capital (ROIC) over time. If a company fails this quantitative gauntlet, you stop. You don't get emotionally attached, you don't listen to the story. The numbers must work first. Step 2. The qualitative investigation, the scuttlebutt. If the numbers look good, now you become a detective, just like Buffett with American Express. A. Understand the business model. Can you explain in a single paragraph how this company makes money? If not, it's in your too hard pile. B. Identify the competitive moat. What protects this company from competitors? Is it a strong brand, like Coca-Cola? A network effect, like a credit card company? Low-cost production? High switching costs for customers? A moat is essential for ensuring the owner earnings will persist. C. Assess management. Read the last 5 years of shareholder letters. Is management honest and transparent about their mistakes? Do they talk about allocating capital intelligently? Do their compensation incentives align with long-term shareholder value, or are they focused on short-term stock price? D. Talk to people. If possible, talk to customers of the company. Talk to employees. Talk to suppliers. Read industry trade journals. Try the product yourself. Get a feel for the business beyond the annual report. Step 3. The final executive decision. You have now done more work than 99.9% of all other investors. You have a deep understanding of both the financial reality and the business reality. Now you act. You decide if the business is a wonderful company, and if the current stock valuation offers you a sufficient margin of safety. If it does, you buy. And you don't buy a tiny tester position. You make a meaningful investment, because you have the earned conviction from your process. This is the essence of beating the market. Thorough analysis leading to concentrated positions in your best ideas. This is how you build true and lasting wealth. The antithesis to this disciplined process, the path of the 99%, is a chaotic and emotional approach to stock picking that almost guarantees failure. The average retail investor's process is a haphazard collection of tips, headlines, and hunches. They might hear a stock mentioned on a financial news show and buy it a few minutes later without having ever even looked at the company's website, let alone its 10K. They might buy a stock because a friend at a cocktail party said it was going to the moon. They might buy a company simply because they like its products, without any analysis of its financial health or valuation. The classic, "I love my iPhone so I'll buy Apple" stock approach, which can work out, but is based on luck, not process. The investor on this path is a passive recipient of information, not an active investigator. Their portfolio becomes a random assortment of story stocks, speculative bets, and yesterday's winners. When the market falls, they have no foundation of conviction to stand on. They don't know what their companies are truly worth, so they can't tell if the price drop is an opportunity or a warning sign. Their only guide is the price itself, so when the price goes down, they panic and sell, often at the absolute bottom. They violate the cardinal rule of investing: buy low, sell high. Their process, or lack thereof, forces them to do the opposite. They are doomed to a cycle of buying into hype and selling into fear, churning their account and slowly eroding their capital. It is a path of immense stress and profound financial disappointment, a direct result of refusing to do the work required to become a true owner. The direct financial connection of applying this disciplined, owner-centric execution model is the single most important factor in your long-term portfolio growth: your behavior. The greatest advantage an individual investor has over the professionals is not intelligence, but temperament. By building a process that gives you deep earned conviction in your investments, you insulate yourself from the behavioral errors that destroy wealth. When the market crashes 30%, the investor on the path of the 99% sees their net worth plummeting and sells everything in a panic, locking in their losses. You, having done the owner's audit on every company you own, will look at the crash with excitement. You know your companies are still generating the same strong owner earnings they were a month ago. The only thing that has changed is the price tag. The market is now offering you the chance to buy more of these wonderful cash-generating machines at a 30% discount. While others are panicking, you are calmly and rationally deploying your capital, buying more shares at incredible prices. This behavioral advantage is the ultimate financial superpower. Over an investing lifetime of several market cycles, the person who can avoid panic selling and instead be a buyer during downturns will produce returns that are orders of magnitude higher than those who are swept up in the market's emotions. Your rigorous process is not just about finding good stocks. It is about building the psychological fortitude to own them for the long term, through good times and bad. It is the bridge between knowing the right thing to do and actually being able to do it. And that bridge is paved with the hard work of fundamental analysis, the CEO mindset, and the unshakable conviction that you are not just a holder of stock certificates, you are an owner of businesses. You have made an incredible investment of your time and focus today, and what you've acquired is more than just a formula. It is a new lens through which to see the entire world of business and finance. You now possess the mental tool to strip away the distracting facade of accounting and see the true beating heart of a company, the river of cash it generates for its owners. You can now distinguish between a business that is merely running on a treadmill, spending every dollar of profit just to stay in place, and a true compounding machine that gushes cash, making its owners richer year after year. This ability to see the reality beneath the surface is the single greatest advantage an investor can have, and it is now part of your intellectual arsenal. But it's crucial to understand that this powerful system of analysis is a network of interconnected mental models. What you have mastered today is a single, vital piece of that network. The owner earnings calculation tells you with stunning clarity, what a great business is. It allows you to identify the cash printing machines. But knowing you've found a Ferrari doesn't tell you what price you should pay for it. The what is useless without the when and the how much. You have the key to the engine, but you don't yet have the map that tells you where to drive or the discipline to wait for the right price to buy the car. The video that is now appearing on your screen is not a random suggestion. Think of it as the next piece of the map. It is the essential link that connects what you have just learned to its practical, portfolio-building application. It is the bridge from identifying a great business to knowing with confidence when to buy it, when to hold it, and even when to sell it. It addresses the other half of the value investing equation. Price. Having the world's greatest company in your sights is a waste if you overpay for it. The next step in your journey is to master the principles of valuation and margin of safety, the very disciplines that turn a great business into a great investment. Many will stop here. They'll feel satisfied with the powerful tool they've just acquired and will fail to integrate it into a complete system. But for those of you who are truly serious about achieving financial freedom, for those committed to adopting the complete CEO mindset, the journey doesn't end, it accelerates. The choice you have right now is more than just a click. It is a declaration of intent. It is a choice to move from being a student to becoming a practitioner. It is your decision to complete your mental arsenal. Continue your ascent.